Welcome to GRE. I'm your host, Keith Weinhold. Does America really have a housing shortage? And if so, how long will it last? Those answers and more with an expert guest and I today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Nantucket, Massachusetts to Pawtucket, Rhode Island, and across 188 nations worldwide. America's favorite shaved mammal on a microphone has got his slack-jawed act back on track for another wealth-building week with you. I'm Keith Weinhold. This is Get Rich Education. I'm still not wearing a pair of knockers, and I've returned here to bring you more value than your HOA dues. It's kind of crazy that America first put a man on the moon, and we're the first nation to put a man on the moon in 1969, and yet today we have trouble housing our own people here on Earth. Shortly, we're going deep on, does America really have a housing shortage? First, sometimes real estate investors can learn lessons from the stock market about the future direction of housing prices and demand, and just simply what assets people have demand for. How AI is disrupting some stock sectors has been rather germane lately. One CEO made this perfect example. It's about how two different stocks, travel search engine Expedia and Delta Airlines, those two stocks were once closely tied together. Their share prices used to be correlated, but they've gone in separate directions. See, Expedia offers you a service that can be replicated by bots, but Delta has actual planes that take you somewhere, and it's hard for AI to replace that. This is why there's been a recent push toward more tangible stocks and tangible assets, a divergence, an attraction to assets that give you a share of either a tangible good, or in the case of something like an airline, a service that's directly tied to something tangible. And similarly, commodities like gold, silver, and copper cannot be replaced by AI. Neither can real estate. There is a growing sense to own things that can't be disrupted, dematerialized, and demonetized by AI like so much software can. In fact, as overall stock market valuations are lofty, some people have become rather wary of an AI speculative bubble that, perceptive to this demand, just a few weeks ago, Goldman Sachs introduced an everything but AI index. Yeah, where you can invest in a basket of companies that are sheltered from AI disruption. This everything but AI index that's attracting investors. And in fact, there's another trend that interfaces with real estate that just launched recently too. Today, you can wager on future home prices through the platform Polymarket. Yes, place bets for profit or loss on the future direction of the median home price. In fact, one recent college graduate joked, "I was born too late to afford a house and born just in time to gamble on people who can buy a house." Yeah, you're probably familiar with Polymarket by now. It's the prediction market that lets you speculate on things like elections and Fed rate decisions and various geopolitical events and other real-world outcomes. Well, they have launched a set of real estate markets that allow users to bet on future home values. The way it works is that you can wager on future home values in New York, Los Angeles, Miami, San Francisco, and Austin, Texas, as well as U.S. national home values. So that's 6 different markets. Now, I haven't gambled on Polymarket. I have checked it at times to get an idea of where people really think markets are headed or what's going to happen next, because rather than major media, where sometimes as a hype machine, they create headlines that scare you in order to try to get clicks, well, instead of all that, regular people are placing their money on Polymarket, and you can look at what that action's like, because that can be a more reliable harbinger of future price direction. At last check, with a national median home price of about $420K, with the numbers Polymarket is using, 1 month from now, 66% of people think that home prices will rise. And it's more nuanced than that. You can bet on just what price range you believe home prices will fall into 1 month from now. And this is nothing that I recommend wagering on, but besides an interesting trend, yeah, you can get that idea of where real people actually believe markets are headed. As we're about to talk to national housing expert Rick Sharga on whether or not we really have a housing shortage, we've got new data about the level of housing permits. Of course, housing permits are a gauge of the level of future housing inventory, because after a permit is issued, it's typically 6 to 12 months until a single-family home is built. But I'll share that with you near the end of the show, because it makes sense to cover this with you in chronological order. We'll discuss housing supply first, and then I'll tell you about the future supply direction based on housing permits. Now, from the inception of this show in 2014, I talked about the why of real estate investing before the how. With anything in life, it's only when you truly know why you're doing something that you'll profoundly care about the how, and you'll want to do it well. In fact, when I do an in-person real estate presentation, one of the modules that I teach most often is simply called Why Real Estate. The biggest why is not altruistic, although that matters and that's part of it, but instead, it's that real estate pays 5 ways. That's the biggest why. Any GRE devotee knows that the 5 ways are simultaneously paid are appreciation, cash flow, ROA, tax benefits, and not inflation hedging, but specifically inflation profiting. Yet I have found multi-decade real estate investors that don't understand this. The most valuable hour that you can spend is knowing all the ways that you're paid and seeing and believing how your total rate of return of 20%, 30%, or even 40% is not far-fetched or risky, but it's actually common and even estimated conservatively. If you're initiated on this, you already know, but if you aren't, it can sound a little hard to believe what I just said right there. I recently reshot the entire Real Estate Pays 5 Ways video course, and it's the most valuable hour of investing video content that you're likely ever to see. It's premium masterclass level content. I'm just giving it away for free because people need to know this. And actually, on the newest shoot, I've condensed it down into just 40 minutes of content across the 5 videos. One instructional video for each of the 5 ways you're paid. The videos average 8 minutes, so that's about 40 minutes total. and they build on each other. So at the end of each one, you get to see your cumulative rate of return. It just keeps adding up, and you know exactly where all of the numbers come from. That's why it's more conducive to video form than audio form. I know that many of you have seen it, but if not, it is foundational, and I cannot recommend it enough. It's free and available to you now at getricheducation.com/course. Get that now while it's on your mind at getricheducation.com/course. More next. I'm Keith Weinhold. This is Get Rich Education. Flock Homes helps you retire from real estate and landlording, whether it's one problem property or your whole portfolio, through a 721 exchange, deferring your capital gains tax and depreciation recapture. It's a strategy long used by the ultra-wealthy. Now, mom and pop landlords can 721 their residential real estate. Request your initial valuation. See if your properties qualify at flockhomes.com/GRE. That's FLOCKhomes.com/GRE. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship Program when you speak to a Freedom Coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Is America really short millions of homes? If so, that doesn't mean every market is undersupplied and prices can only go up because of it. If there's a housing shortage, why are prices falling in some cities? So the shortage, is that something that's real, or is it just misunderstood? And you're going to learn what it means to you. I'm Get Rich Education's Keith Weinhold, along with an intelligence authority today that usually gets it right. In fact, I found an old clip of him on Bloomberg where he suggested home prices bottoming in 2011, and as it turns out, they sure did. Today, together, we're answering the question, does America really have a housing shortage? And my guest has often appeared in major media, CNBC, Fox, NPR. He's the founder of the C.J. Patrick Company. Hey, welcome back to the show, Rick Sharga.
Good to see you again, Keith. Thanks for inviting me.
You know, it's funny. 4 years ago, Rick and I found each other, and we sort of checked each other out. I found him to be an authority that just doesn't go on saying this bombastic and absurd stuff just to get attention. Instead, he quietly gets it right. And when he knew I had a real estate YouTube channel, similarly, I resonated because I'm not one of these people that's constantly saying that housing prices are going to crash just to get views. And then those crash people never follow up when they're wrong, and they've been wrong for about 14 years now. But Rick, rather than prices, we're here to understand if there's really a housing shortage today. Most agencies believe we have a shortage. Moody's will tell you 2 million, Zillow 4 to 5 million. Congressional Republicans have gone on to say 20 million. I sure don't know about that. And then, yet, Rick, sometimes at the same time, you do see these conflicting stats where it says that sellers outnumber buyers today, which sort of flies in the face of a housing shortage. So what is your take amidst all this?
Well, Keith, I think what we're seeing is a fairly obvious example that if you torture data enough, you can make it say anything in the world you want it to say. And there is a lot of confusion about how much of a housing shortage we really do have. It's not like we have 20% of the population unable to find anywhere to live. Most people still prefer to live indoors, and they've been able to do so. But the fact of the matter is that all of the math suggests that we are underserved in terms of the number of housing units available across the country. And we can go through some of the math. The big question, of course, is how many houses are we short? How many housing units are we short? And the reason the numbers are all over the place, and as you suggested, let's set aside the Republican estimate of 20 million because there's certainly something political going on there. But the estimates range from around 1 million to as high as 5 or 6 million. And the reality is all of those estimates are counting something different. Some are counting housing growth versus population growth. Some are counting vacancy rates compared to historic levels. Some are counting inventory available for sale today versus inventory available to sale in prior years. So each of these organizations, and they're all pretty reliable organizations. Moody's is certainly good. Zillow's research team is top notch. Fannie Mae and Freddie Mac, the National Association of Realtors, none of these people are hiring dime store economists. They're all good folks, but they're all measuring something slightly different, which is why these numbers come out all over the place. And one of the fundamental challenges is trying to figure out housing shortages compared to what or compared to when. All of these estimates assume that there was some point in history when we had exactly the right number of housing units to suit the needs of the population. So they start with some point in time, and I think if you did enough research, you'd find they all start at slightly different points in time, and then kind of work their way forward from that and come to very different conclusions, again, based on where they started and where they ended up and what they count. The one thing I would push back on a little bit from some of your comments in the intro is that I am highly, highly skeptical, extraordinarily skeptical of the reports that talk about how many more sellers we have than buyers, because that makes some wild assumptions about the number of people that are actually interested in buying a house. And I've never seen any research methodology that's really nailed that number accurately, because nobody knows if you're thinking about buying a house right now until you go to an open house, until you do a search on Zillow or Realtor.com or Homes.com, until you actually are applying for a loan or making a deposit. So the notion of being able to mind read 340 million Americans to figure out how many of them are interested in buying, I think is a neat trick. But I do think it's at least in part one of those methods that people use to get a lot of clicks to their website.
Right. This whole thing of, and I think when we talk about sellers versus buyers, that's shorthand. What we really mean there are some stats out there that show that prospective sellers outnumber prospective buyers in some cases, which, I think I agree with you there. I doubt that as well. And of course, I think you're getting on some of the nuance here. We're trying to predict how some people would behave. For example, how much pent-up demand is there when we're talking about sellers versus buyers and we're talking about a shortage? For example, say the 28-year-old living with their parents that could move out and afford to buy a home if mortgage rates hit 5%. Like, for example, how do you count that, or how would you even know to?
It's a valid point, Keith. And I think that fundamentally is my question with that particular report. You really can't count that person. We do have some metrics that we follow. And it's funny you mentioned that 5% mortgage, because as we record this, mortgages have broken that 6% threshold for the first time in a number of years. And just about every kind of mortgage you could buy right now is below 6%. So that's a good thing. And every time we've gotten close to that 6% mark in recent years, since mortgage rates doubled back in 2022, we've seen a huge influx of people applying for purchase loans, for those mortgage loans to buy a house. Those numbers are up somewhere between 13 and 15% year over year right now. And that's before we've really had these mortgage rates dip below 6%. So to me, that suggests there really is pent-up demand out there. And I judge that just based on what I see in terms of the number of people actively applying for a loan.
Yeah, there's a lot of nuance here. HUD tells us that we have more homeless people than we've ever had in this nation. So that's sort of an extreme affordability problem, to your point earlier about how most people want to live indoors. And I'm sure not making light of homelessness. It's a sad situation, but we're always going to have homeless people, regardless of whether we have excess housing or a housing shortage. We have about 146 million housing units in the United States. The census shows and suggests that 8 million of those 146 million are housing units where people have doubled up and are sharing space with non-relatives. That's one way to think about the level of pent-up demand within the shortage.
I don't know if that's a result of shortage necessarily, or if that's a result of having the weakest affordability for people looking to buy homes that we've had in over 40 years. The last time affordability was this bad was the 1980s. And the reason affordability was bad back then was because mortgage rates were at 18, 19, 20%. And it made it very difficult for people to afford homes. But we're coming out of a very unusual cycle. And this is a little bit off topic from our inventory question, but it's the only time in U.S. history when two conditions have hit the housing market back to back. If you go back to COVID, coming out of COVID, we saw home prices go up nationally by over 50% in about 18 months. It was a huge, huge, unprecedented increase.
Yeah.
And right on the heels of that, as inflation started to get out of control, the Federal Reserve had to take pretty extreme measures to get that back down. So they started playing with the Fed funds rate, and we saw mortgage rates double in 2022. In the history of the country, according to Freddie Mac, we've never seen mortgage rates double in a calendar year. And in 2022, they not only doubled in a calendar year, they doubled in the space of a few weeks. So we're coming out of a period where home prices went up by over 50% and then mortgage rates doubled. And it just crushed affordability. So the people that have been looking to buy a $400,000 house suddenly realized they could only afford a $200,000 house, and there were none of those around. It's really why home sales have gone down as rapidly as they have.
Volume of sales.
In 2021, we sold 6 million existing homes. In 2022, it dropped to 5 million. And for the last 3 years, we've been sitting at around about 4 million annual sales of existing homes. And again, that doesn't suggest a lack of inventory, a lack of homes, because there are fewer people buying and there's more properties staying on the market longer. But the underlying numbers, the underlying metrics we would look at are where we can start to kind of deduce that there aren't enough homes. For example, you mentioned that there are about 146 million housing units across the country. Most recent census data I have from the end of 2024 says it's about 147, 148 million. So it's up just slightly from your number. That represents a growth of about 6.7% in housing units between 2010 and 2024.
Okay.
During the same period of time, the population went from about 309 million to about 341 million. And that represents a growth rate of about 7.4%. So if everything else stayed equal, your population grew at a faster rate than your housing units did. And that suggests that even if the number of housing units was ideal back in 2000, it's somewhere less than ideal by the time we got to the end of last year.
We're talking with Rick Sharga. He's the founder and owner of the housing market intelligence firm, the CJ Patrick Company. We're answering the question, does America really have a housing shortage? We're getting a yes there. And before we're done, we're going to talk about how long could the shortage persist. But Rick, you spoke to affordability, and I think that has a lot to do with the nuances within the shortage. And that brings up shortages within the luxury tier versus shortages in the entry tier. And the entry tier is really what a lot of our listeners and viewers are interested in because we're used to buying those as rental properties. So can you tell us about that?
It's a great point, Keith. And what we've been talking about so far is kind of a structural shortage in the overall number of housing units that could be purchased, could be owner-occupied, could be rented. And one of the culprits there, and I will answer your question, I promise, one of the culprits there is that builders simply haven't built that much. If you look at the long-term average, like 20, 25 years, the average number of housing starts was somewhere between 1.3 and 1.4 million a year. coming out of the Great Recession in 2010, so you look at that last 15-year period or so, 12 of those years, they've started less homes than that long-term average. So builders simply haven't been keeping pace, not only with population growth, but also with just the ability to create enough homes in general to offset the number of homes that are obsoleted every year, that get bulldozed every year. So there is a structural shortage. To your point, if you look at inventory available for sale, we are up about 9% year over year, but we're still down about 15% from where we were prior to the pandemic. So there are fewer homes for sale than there were back when the market was functioning more efficiently. The most drastic shortage is at the entry level. Builders simply have not been making a lot of entry level properties. There's a reason for that. There's some independent research out there, including some research from Fannie Mae, that suggests that the pre-construction cost a builder has to absorb before they break ground is over $100,000 across the country on average. Higher than that, where I'm calling you from today in California, it's about $120,000 there. If your table stakes are $100,000, $120,000, it's really difficult to make a profit on an entry-level property. So the builders, I think understandably, have been focusing on higher dollar, higher value properties and not replenishing that supply that we need for first-time buyers and the kind of properties that real estate investors tend to like. The other problem we've had, Keith, is that when those mortgage rates doubled, the people who had purchased those entry-level homes refinanced into a 2.5%, 3% mortgage and are now sitting on a $300,000 property, let's say, or a $250,000 property with a 2.5% mortgage. And if they wanted to trade up, they'd be trading up to a $400,000 or $500,000 house with a 6% mortgage. And they simply can't afford to do that. So the combination of entry-level owners staying put at much larger numbers and builders creating new entry-level homes at much smaller numbers has really created kind of a crisis of inventory at the entry-level segment of the housing market.
Yeah, when we talk about that crisis of inventory in what's available, I'm not talking about shortage numbers now. I'm talking about the active listing count. This means more or less available homes to buy. This includes single-family homes and condos. We have an active listing count of around 1 million today. The historic average is around 2.2 million, and that peaked near 4 million during the global financial crisis. So today, only about 1/4 as many active listings, available homes.
As at the peak.
Yeah.
Only about half as many as let's call it a normal market. And that's one of the reasons. I think the first time you and I spoke on your podcast, we were talking about all the online snake oil salesmen who were predicting a home price crash. But that's one of the reasons why home prices haven't crashed and why they've kind of continued to grow, at least at a modest pace, and in some cases now are starting to decline a little bit. But that lack of inventory on the market, when you don't have enough inventory to meet demand or just barely enough to meet demand, that means that seller doesn't really have to negotiate all that much. That means that buyers are kind of at a disadvantage. And so as long as that's the case, you'll see home price stability. That doesn't mean that every market's going to see prices go up. But if you look across the country right now, if you look at markets where home prices are down even marginally year over year, you're looking at the Gulf Coast states, you're looking at some other southern markets, Las Vegas, Phoenix. You're looking at some outlying markets like Boise, Florida, certainly, and Texas. And those are markets where inventory is actually considerably higher than it was a year ago, and in some cases, considerably higher than it was back in 2019. If you look at markets where prices are still going up a lot, Midwest, Northeast, those are still markets where there's not enough inventory to meet demand. So that relationship between available inventory for sale and demand is really what drives pricing.
This whole discussion, which is really about the supply, just in the Economics 101 Adam Smith of supply versus demand, a lot of people, just like including my dad, when I was telling him about housing, something he doesn't follow, and I told him that prices are up the most in the Northeast and Midwest, that surprised him. He was like, oh, well, population growth is lower here and lower than Pennsylvania, where he lives. And that's when I brought up, well, they're underbuilding there. So when parsing this by geography, Rick, I think another way that we can do it is parsing the housing shortage by the single-family homes versus apartments, because it's pretty well documented that nationally, apartments could be seen as overbuilt and single-family is underbuilt. Do you have any details with respect to that?
We can talk a little bit about that. And quick shout out to both of our home state, Pennsylvania.
Yeah.
Philadelphia actually had some of the highest annual price increases in their home sales last year. But part of that isn't just because they haven't been building a lot in Philadelphia or the suburbs. It's because we see people moving from higher price markets into lower price markets. So we have people actually commuting to New York who have bought homes in Philadelphia or the Philadelphia area. They can get much more house for their money there. They're not subject to some of the wage taxes that happen in New York State. They just get on that Amtrak and train into the city every day. So there is some of that going on across the country, too, as we still see net migration of people moving out of states like California, New York, and Illinois into nearby states where the cost of living is much lower. That's slowed down since COVID, since a lot of companies have been requiring people to come work back at the office. But it is still happening, and it is still happening in generally the same direction. You raised the issue of inventory for rental units versus inventory for, let's say, owner-occupied properties. We have seen a plateau in the number of single-family rental homes. So the stuff you're hearing out of D.C., that you're seeing in the media about the really important ban on institutional investor buying is really much more sizzle than substance.
Oh, right.
Institutional investors own and are buying a fraction of the housing units out there. But we've seen over 1 million apartment units come online in the last 18 months. It's about the largest number of apartments that have sprung up and in that short a period of time on record. And we've gotten to a point where in some markets, there's actually a little bit of an oversupply of those apartment units. Now, that will balance itself out over the next couple of years because multifamily building starts are way down too. So we're not seeing a lot of activity there as builders hold off waiting for this new inventory to get absorbed. But to put it in perspective, vacancy rates went from near zero back during COVID in those apartments to over 6% last year. Rental rates have gone down from 15% year over year increases back in 2020, 2021 to negative numbers nationally in the last year. Just
talking apartments now.
Just apartments. So we have a short-term mini glut, if you will, of apartments. It will be absorbed rapidly. We have 92 million people between the ages of 26 and 54 who have either formed households or are about to. A lot of them would like to be home buyers, can't afford today's prices, so they're renting instead. And about 5 million people a year are turning 35, which is when, we parents start literally kicking them out of the house. So I think that rental overage will resolve itself really in the next 12 to 18 months. And if the builders don't start building new inventory by that point, we'll wind up with another shortage. On the housing front, I'm of the opinion that we're at least 1 million homes short compared to what demand should be. I think the number's probably somewhere between 1 and 2 million. And again, I'm doing that simply based on a slight decrease in vacancy rates, population growth, and the aging of the population. What could throw all of our numbers off, Keith, is one of the X factors in demographics and population, which is immigration. Population growth, if it's organic, if it's by birth, does have an effect on housing to an extent, but it's more nuanced and it takes longer to really show itself. If you're dealing with adult immigrants coming into the country, particularly immigrants who are coming in for jobs and have income that they can spend on housing, your housing demand goes up quickly. And that can have some local market repercussions depending on where the immigrants are going in.
Philadelphia is not a coastal city. Its cost of housing is surprisingly low to a lot of people, but it's not on a coast. Just look at a map. Well, Rick, as we're winding down here, how long could the housing shortage persist overall?
I think we're in a period of time right now where builders are reluctant to overbuild. They got caught in the Great Recession with about a 13-month supply of homes available for sale. And then as home prices crashed, they were competing with their own inventory from the prior year. And many of them took a real beating financially during that period of time. So I don't expect we'll see builders overbuild anytime soon. And that tells me that we're probably looking at least another 3 to 5 years before we can have a rational conversation about housing numbers kind of leveling off to be where they should be. We mentioned immigration. That is an X factor. That could extend the housing shortage if we start to see more immigration coming into the country. It could mean that we don't need as many houses as I suspect if we have fewer people coming into the country. And the other X factor here is the boomers. The baby boomers of any generational cohort probably have the highest homeownership rates right now and ultimately will age out of their properties. They've stayed there longer than any prior generation has, and that's also contributed to the inventory shortage as opposed to the housing shortage. But as a friend of mine said, and it's a little macabre, but as he says, boomers will eventually leave their homes either vertically or horizontally. So that will bring some inventory back to the market as well.
Housing supply, it is rather inelastic, and we're probably going to be in this shortage for a number of years. Well, Rick, tell us how and why people consult with you, and then just how they can do that.
Yeah, I work with mostly companies that are in the real estate or mortgage industries, Keith. I typically prepare a lot of market intelligence reports to them. It's real estate data, economic data, mortgage data. For some clients, I do foreclosure reports so they know what's going on in terms of delinquencies and defaults. For others, I do research on investor purchase activity, what they're buying, what they're selling, what they're paying, where they're doing all this. So anything that's data related to real estate data, mortgage data, economic data, I'm kind of neck deep in. And I'm very easy to find on either LinkedIn or X. So if anybody's listening today and wants to connect on those platforms, just reach out and tell me you saw me on the GRE podcast, and I'll know you're legit.
Housing supply is coming up short, but Rick never does. It's been great having you back on the show.
We'll do it again soon, Keith. It's great talking to you.
Do we really have a housing shortage? The answer is yes, and the number of units short is 1 to 2 million. The shortage is worst in the entry-level home segment, which matters so much to us as investors. We are owning an asset that's going to have sustainable demand for quite a while into the future. Rick indicated that it could take perhaps 3 to 5 years just to get back into balance. Now, we recently learned that there were fewer housing permits issued last year than there were in any year since 2019. And housing permits are an indicator of the future home supply. They had their recent peak 5 years ago with 1.75 million, and last year there were just about 1.4 million. So home permits issued are 19% lower today than they were back in 2021. This is a harbinger of supply because from the time that a permit is issued, it takes 6 to 12 months to complete a single-family home. It's about 6 months to build a tract home and closer to 12 months for a custom home. For apartments, it can take in excess of 24 months to deliver. That period of time from permitting to completion. So nationally, we should continue to see scarce supply in the 1 to 4 unit space, keeping upward pressure on prices. Again, for the most valuable 40 minutes of educational real estate investing material around, you can access my premium Real Estate Pays 5 Ways Masterclass of 5 videos totally free. And you know how I operate. I don't try to upsell you to some paid course either. It's just truly free. I'll send it to you. You can access it at getricheducation.com/course. Coming up on future episodes here on the Get Rich Education Podcast, we're about to go on a run. The next stretch of GRE is loaded. We've got fresh topics with some game-changing monologue content that I'm going to share with you. New guests, distinguished guests. Next week, the youngest guest to ever appear on the show is going to be with us. He's a 19-year-old college student with a real estate investing-related major. How does he see Gen Z's financial world? Is there any hope at all? The following week, we're going to break down an innovative way to sell properties that could completely change how you think about your exit strategy when it's all done, when it's time for you to retire from real estate. Rather than a 1031 exchange, which would just keep you in the real estate game and with more of it, do a 721 exchange into a real estate fund, have no more assets to manage, no more property managers to manage, total capital gains tax deferral, and still get financial upside. And then just 4 weeks from now, it's Get Rich Education Podcast, episode number 600. Debt is the American dream. So if you're serious about building wealth, be sure to follow or subscribe to the show. If you've already done that, I would really appreciate it if you told a friend about the show. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.